This is the Retirement Key Podcast with Ryan Oliver, certified financial planner of Abich Financial Services.
The reality is retirement is not just a math problem, it's emotional as well. And when uncertainty shows up, whether it's the markets or the news or just that shift into actually living off of your savings, people feel the urge to react. And even logical, well-prepared people sometimes still make some bad retirement decisions when they're under stress. So today we're breaking down why that happens and, more importantly, how to avoid making decisions that can quietly damage an otherwise solid plan. And to help us do it, we've got Ryan Oliver, financial advisor with Abich Financial Services. Ryan, I want to start broad. When we say stress in retirement, what does that actually look like in real life? And why can otherwise smart, logical people suddenly make reactive money decisions?
Yeah, Casey, retirement stress specifically doesn't usually look like panic. It looks like uncertainty, people that are just, less certain about decisions they've previously made. It's a couple watching, a 15% drop in the market, which is really run of the mill, to be honest, if we're honest with ourselves, and asking themselves, should we cancel the trip that we planned and wanted to go on? Or it's someone waking up at 2 a.m. because they can't stop thinking about their money or the markets or whatever's going on. A recent retiree checking on balances every single day because they don't have paychecks coming in anymore, and suddenly the portfolio is the only paycheck that they've got. So stress, like you said, can come from market volatility. There's health concerns, inflation, family issues, just life that happens during retirement. And honestly, too, it's not even just the logical things like that. It's adjusting to a major life transition. You're a whole new person during retirement. And people often expect the retirement stress to be financial, but a lot of it's emotional and identity driven because you just left something that you are a stage in life that you've been, participating in for 20, 30, 40 years, sometimes longer. So unless we address what stress looks like in our own life proactively prior to making that retirement jump, we run the risk of letting financial lives rule everything else and just our overall, feelings and comfort level in retirement, which is never a recipe for success.
I think you kind of just touched on it a little bit, but why do you think retirement does feel different emotionally than our working years, even if somebody has that solid nest egg sitting behind them?
Yeah, because during your working years, not only do you have the nest egg, that whatever you've got, but you also have a really powerful safety net, which is future earnings, right? Future income. If markets fall at age 45 and you're still contributing, still earning, and you're still accumulating, you may not be necessarily as concerned with that. Whereas retirement flips the equation. You stop building and you start drawing. And for many people, that's the first time that their life savings feel finite. You feel like you have a point where hey, I don't have all the money or all the earnings potential in the world. And that psychological shift is there too that I alluded to. It provides structure, purpose, routine, work does, and that sense of progress, right? And retirement asks people to ask a difficult question, which is who I am now, and that emotional adjustment's often bigger than people anticipate.
Yeah, it can be huge. What are the most common bad decisions under stress that you've seen retirees make, the ones that maybe feel helpful in the moment, but they can really cause some damage later?
Yeah, and you said it best. I mean, the biggest one, obviously, is making large portfolio changes in the middle of scary periods, right? People move to cash or make a huge adjustment to their overall investment philosophy because it feels safer in the moment and taking control feels important. But then, the problem is you often lock in losses doing things like that and placing trades in stressful moments. Everyone says that they're not going to be the person to do that. But then when you're faced with all of the things we've been talking about and you're retired and then time's finite, sometimes you feel the need to take a bull by the horns and do something. Another common one is abandoning a long-term plan after one bad year. A retirement strategy built for 30 years shouldn't be edited when you have a bad quarter or a bad year. It should be expected that those things will come up. And then, finally, I would say chasing whatever's right in the moment is one thing that people do when they're stressed and they want to take that control. You're looking at whatever's popular, whatever's being pushed, high dividend strategies, gold, speculative investments, concentrated bets in AI or tech, strategies that promise certainty. There's a whole host of things that people do when they're just trying to take action.
Why is that pre-retirement or that early retirement window specifically such a dangerous time to be making these emotional changes that we're talking about compared to somebody, let's say, who's maybe 10, 15 years already into their retirement?
Yeah, early retirement is a dangerous time to make those emotional changes because the period is uniquely vulnerable because several things are happening at once, right? You're making what are some of which are irreversible decisions. Decisions about Social Security timing, healthcare elections, pension choices, withdrawals, tax strategies, portfolios, setting things up differently. And at the same time, the portfolio is extremely sensitive to early losses. I mean, that's something that we call sequence of return risk in our industry. We've talked about it before on this channel, where a major downturn early in retirement can have an outsized impact because withdrawals are beginning at that exact same time. Beyond the math, though, emotions are elevated in that early retirement window because people are leaving their careers and their routines and identities and some sense of certainty behind. So we've seen incredibly intelligent people become much more reactive in the final few years before retirement because the stakes start to feel real in that moment. And because of those, mathematical reasons, you can make a big impact on a long-term plan.
We talk a lot on the show about that idea of tinkering. So why do you think stressed people start doing something just to feel in control? And how does that quietly derail a retirement plan?
Yeah. Stressed people start to do something because humans generally prefer action over just sitting in uncertainty, right? Doing something, even if it's the wrong thing or tinkering, to use that language, can feel temporarily better than just sitting there and doing nothing, like selling investments, changing managers, moving to cash, dramatically shifting allocations, anything that gives you that feeling of being in control or responding to the environment that's happening around you. But the problem is that the emotional relief that you might feel from taking that action and the financial benefit aren't the same thing, right? Human psychology, one thing that I say all the time to clients and at other events is that human psychology is completely incompatible with investment principles, right? Typically, people want to buy when they're comfortable and sell when they're uncomfortable, which is the exact opposite what you want to do in a long-term plan. And sometimes this activity that people are doing, early in retirement or even later, becomes a substitute for an actual formalized retirement strategy, and retirement mistakes don't come from bad decisions. They come from trying to reduce anxiety in the moment.
Let's make this practical. Ryan, what guardrails do you like to have in place for your clients to help prevent these stress decisions that we're talking about?
Yeah, so good retirement plans mean building good decision-making systems before stress arrives, right? Before we feel uncomfortable. You can do that by having a formal written retirement income plan, both for good environments and bad environments. In other words, how are you getting paid? How are you paying yourself, in an environment where the market is cooperating, or how are you paying yourself when the market's not doing well? Have you built that plan in? Because that's going to happen sometime throughout the course of a decades-long retirement. You should also establish some proactive rebalancing rules, right, that are non-emotional. Because like I just shared, rebalancing is inherently uncomfortable, right? Because you're selling the thing that's been working and buying the thing that's not performing as well, right? So it's counterintuitive, but it's healthy for a good retirement. So having that plan and guardrail in place, and following those rules and that structure can help you avoid some financial mistakes. And you need to set expectations with yourself by doing some stress tests or otherwise working with a trusted advisor so that you can understand what volatility might feel like. That's looking at your portfolio statistically and understanding the risk that you're taking on, right? You don't build a portfolio or a retirement plan assuming perfect markets. You need to expect those difficult periods, and assigning some numbers to that can really help. The best plans aren't designed to eliminate uncertainty. There's no way to do that, but they're designed to keep people from making permanent decisions during temporary stress that can cause, really adverse implications in a retirement plan.
Confidence seems to be a huge theme here. So, Ryan, why does confidence matter just as much as returns? And how do you help somebody trust their plan so that they do not override it in a scary moment?
Yeah, confidence is so important in a retirement plan. One of the mantras that we say all the time is relaxing into retirement. And part of being able to relax into retirement is knowing that you have a plan that's built to withstand, some ups and downs in the market. But a retirement plan only works if people can stick to it, right? If someone can stick to a plan, especially in stressful situations. A mathematically perfect plan and a perfect portfolio that causes someone to panic is in no way optimal. So confidence comes from understanding why the plan works, right? And running through these scenarios rather than just seeing projected returns on paper and doing simple math. And that's a big part of our role as fiduciary advisors, is translating complexity into a clear and actionable plan. We walk through these scenarios and say, what happens if market declines? Where does your money come from? What happens if inflation rises temporarily or more long term? And what if retirement lasts longer than I expect, right? How do I make sure I'm not going to outlive my money? And the goal is not to convince someone that they're never going to be afraid, because that's silly. We can't do that. We can't promise that. No one can. But the goal is to help people understand that fear is going to happen throughout the course of a retirement. And if we know that it's going to happen, we can have an actionable plan for it that's non-emotional if we think through these actions ahead of time. And that's when confidence becomes durable and you avoid, those emotional mistakes that can cause you to get yourself into trouble.
Absolutely. Well, look, if you've made it this far, you're clearly invested. You are seeking out the right information. You're trying to educate yourself when it comes to your financial future, which is an amazing first step. So when you're ready to take it a step further, when you'd like to get the conversation going with the professionals, Ryan and the entire team at Abich Financial Services are here for you. TheRetirementKey.com is where you can go to get connected. And we've also got all the info posted in our show notes for you as well. We're making it very easy for you today to get in touch. So come on and find us at TheRetirementKey.com.
Thanks for listening to the Retirement Key Podcast. To learn more about Abich Financial Services, visit TheRetirementKey.com.
Abich Financial Wealth Management is an SEC registered investment advisor. Registration does not imply a certain level of skill or training, and the SEC has not approved or verified this communication. Abich only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. This material is for general informational and educational purposes only and is not individualized investment, legal, or tax advice. Investment advice is provided only after engagement under an appropriate advisory agreement. Structured notes, annuities, Roth conversions, and related strategies involve risks and may not be suitable for all investors. Structured notes may involve issuer credit risk, limited liquidity, capped or conditional returns, loss of principal, and protection features that may not apply in all market conditions. Annuity guarantees depend on the financial strength and claims-paying ability of the issuing insurer and may be subject to caps, restrictions, fees, and surrender charges. Roth conversions are taxable events, and outcomes depend on individual circumstances, future tax rates, and investment performance. Third-party rankings or recognition are not guarantees of future results. Endorsements are representative of any client's experience. Criteria and fee information are available upon request. Any hypothetical or illustrative scenarios referenced in marketing materials are for demonstration purposes only, do not represent actual client experiences or guaranteed outcomes, and should not be relied upon as predictions of future performance. Investors should review all offering documents, understand applicable risks, and consult qualified financial, tax, and legal professionals before acting. Past performance does not guarantee future results. Endorser is not a client, and this testimonial has been compensated. Opinions are their own. Compensation may create a conflict of interest. Testimonials may not be representative and are not a guarantee of future results.